Is Zoom a buy or a sell? Let's get started with the model. This is a large cap company, 27 billion market cap. They're trading at $89 a share and they have 308 million shares outstanding. Zoom offers video meetings to people in most countries. It was incorporated in 2011, headquartered in San Jose, California. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They have really consistent free cash flow from 1.5 billion to 1.7 billion. Great margins. They convert 38% of their revenue into free cash flow. Net income is the profit or loss on the income statement. It's revenue minus expenses. That went from 1.4 billion all the way down to 100 million. It grew 500% in 2023 to 600 million, up another 37% to 875 million in the trailing 12 months. Also pretty good margins. They convert 19% of their revenue into net income. Revenue is a sales for the company, and that doesn't look so great. It's growing at about inflation from 4.1 billion to 4.6 billion. We estimated 4 years of future free cash flows. We also estimated a terminal value to all cash flows past year 4, that's 35 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $32 billion. We divide that by 300 million shares. And we get a calculated stock price of 103. They're trading at 89, so they're trading at a 14% discount. It's a buy according to the model. Do you think it's a buy or a sell? Let me know in the comments. There are 100 companies in the same industry as Zoom, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend 161 million in CapEx. These are the investments in property, plant, and equipment. It looks like they're debt-free. They don't pay a dividend. They generate 1.7 billion of free cash flow. That's one of the higher ones in this list. That's pretty much the same as AppLovin, and AppLovin is 5 times the market cap. They're trading at 3 times book value, 31 times earnings, and 16 times free cash flow. They actually have the best price to free cash flow on this list. They should be highlighted, not DocuSign. And their price to sales is between the median average. They're trading at 6 times revenue, which means their market cap is 6 times their revenue. They generate 4.6 billion of revenue. That's more than AppLovin, also more than Cadence, and Cadence is more than triple their market cap, more than FICO, Datadog, and HubSpot. And all those companies are larger in terms of market cap. Their 52-week high is 93. They're trading at 89, so really close to that. So it might not be the best time to buy the stock since they're trading at a pretty high level. If you put $10,000 into this company when they started trading, you would have been at $70,000 after about a year and a half. But if you still held on, you'd be at $13,500 today, a 35% return. They were a huge beneficiary of the COVID shutdown. I wasn't even familiar with Zoom until COVID hit, and then I fell in love with the company. It seemed like the only video conference service that actually worked, and it was millions and millions of people using it, and it still worked fine. Too bad they lost so much market share with competition, but that's life. So to summarize, I have them trading at a 14% discount. I give them a ranking of 5 out of 10. I'm not a big fan of the stock, so would I buy it short-term and long-term? 3 out of 10. They do have good ratio, 7 out of 10. Financials are decent, so I give it 6 out of 10. At least it's going up, but not by that much. Free cash flow is up 18% since 2021. Revenue is up 12% since 2021. They just released earnings this week. Let's go through their slides. It looks like they're trying to leverage the AI boom. They have Zoom AI Companion 2.0, Custom AI Companion, also Custom AI Companion for healthcare and education, and Zoom Workplace for frontline. Last year, Zoom acquired WorkVivo. In this quarter alone, WorkVivo added 3 customers that spend over $1 million each. WorkVivo is for employees to communicate with each other. It really seems like a good addition to this company. I think it'll help them grow. They've added some big customers this quarter. ServiceNow. ServiceNow helps companies automate their workflows. They added Aetna Health and 2 other companies I'm not too familiar with. Here are some milestones for the quarter. A 59% increase in monthly active users. WorkVivo customers increased 72% year over year. And they have 1,250 Zoom contact center customers. That's a growth of 82%. Their total revenue is up a little bit. a little over 1.1 billion to a little under 1.2 billion, up 4%. Enterprise revenue up 6% from 660 million to 700 million. Enterprise revenue is nearly 60% of their total revenue. When they say enterprise, I think they just mean business revenue. So consumer revenue is about 500 million, business revenue is 700 million. Monthly churn is going down 2.7%. That's a percent of customers they lose. And that seems to be at the lowest level ever. Last year was 3%. They have almost 4,000 customers that spend over 100K a year. That's up 7% from last year, which is about 30% of their total revenue. They have a total of 192,000 enterprise customers. So it looks like these 4,000 make up the bulk of their revenue. Of the 1.2 billion of revenue, 846 million is in the Americas, which is up 4% from last year. EMEA, 187 million, up 5%. APAC, 144 million, exactly the same as last year. They have really high gross margin, 76%. That means they convert 76% of their revenue into gross profit. R&D is 19% of their revenue, marketing 31%, G&A 11%. So their operating income is 15.5% of their revenue. 26% effective tax rate, EPS 66 cents, up 47% from last year. Total RPO, remaining performance obligation, so these are outstanding contracts, 3.7 billion. So that's potential revenue for the future. 1.4 billion of that is deferred revenue. This is when they receive payment for a product or service they haven't delivered yet. And then 2.4 billion is unbilled revenue. Their operating cash flow is down 2%. It's down to 483 million. Operating margin 41%. Free cash flow is up 1% to 458 million. Free cash flow margin 39%. And they bought back 4.4 million of their own stock. Here's their guidance for next quarter and 2025. Next quarter revenue about 1.18 billion. Operating income 445 million. They don't give guidance on free cash flow. But revenue for all of 2025 about 4.65 billion. And they think shares will be the same, around 315 million. Free cash flow about 1.6 billion. Here are some of their financials for the last 8 quarters. Revenue is pretty much flat. It's between 1.1 and 1.2 billion every quarter. So not much growth. Except for the fourth quarter of 2023, they did have positive operating income every single quarter. The best was the first quarter of 2025, positive 203 million. Operating cash flow is also positive. The highest was 588 million in the first quarter of 2025. Free cash flow looks pretty good. The low was 180 million in the fourth quarter of 2023. The high was first quarter of 25, 569 million. And they have lots of deferred revenue, which means they'll be recognizing this revenue in future quarters. Number of customers that spend over 100K, it was under 3,500 in the fourth quarter of 2023. Now it's almost at 4,000. That seems to grow a lot each quarter. And you can see their churn has gone down. It was 3.4% 2 years ago. Now it's down to its lowest level. The first time it's below 3% is this quarter. It's 2.7%. Let's look at a stock on Simply Wall Street. It's last priced 89, 26 billion market cap, up 13% in the past week, up 36% in the past year. Looks like the stock has done pretty well this year. And look at this stock chart. It IPO'd in 2019. It looks like around 40 or so. It's hard to tell. And by October 2020, it hit $568. That would have been a nightmare if you never sold and you're still holding now. Imagine buying it at like 80 or 90 and it goes all the way up to 560 and then you watch it come down to below your cost basis. Simply Wall Street's valuation is 129. They say the stock is 31% undervalued. 27 analysts priced this stock at 90. They say it's 8% undervalued. Here's their revenue since 2017. It was 61 million. And then it had a pretty slow growth over the next few years. It was 622 million in January 2020. And then it blew up to over 4 billion 2 years later. And it's gone up since then. Now it's 4.6 billion, but a pretty modest growth since 2021. They added 15 million of debt in 2019, but paid that off, and they've been debt-free for a while. And their equity looks real good. Their equity is 8.5 billion. Most of their equity is cash, 7.5 billion of cash. That's a lot of cash. The CEO's salary was 300,000 in 2018, up to 400,000 in 2023. Now it's currently $10,000. You don't see that too often. Total compensation, $28 million. Tenure as CEO, 13 years. Only one insider activity in the past year, a sell for 14,000 shares. 60% of the company is owned by institutions, 29% by the general public, and 11% by insiders. Vanguard is the biggest shareholder at 8%. Then the CEO at 7%, BlackRock Fidelity, T. Rowe Price, Acadian Asset Management, Cube Research, Dan Scheinman, he's an angel investor. He owns 0.5% of the company. And their employee count went from 1,700 in 2019. Its peak was 8,500 in 2023. Now it's down to 7,400. And the ticker trades are the NASDAQ, Wiener Börse, London Stock Exchange, Deutsche Börse, Mexican Bolsa, Lima Bolsa, Zicha, Euro TLX, BATS Europe, Sao Paulo Bolsa, and the Buenos Aires Stock Exchange. So if you want to learn how to build a discounted cash flow model so you know what stocks to buy, what stocks not to buy, click on the video in the top right corner.